Thank you for joining us for our webinar today, Hidden Tax Opportunities for Dental Professionals. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all of the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Justin Chesbrough and Andy Slinger. Justin and Andy are both CPAs and principals with SVA's Dental Services Group. They provide advisory, accounting, and tax services to dentists and their businesses. They work with dental practices of all sizes, from solo practices to group practices with multiple locations. Justin and Andy use their knowledge of the dental industry to help dentists on many aspects in their practices, including our topic today, hidden tax opportunities. And with that, I will hand it over to Andy to get us started today.
Thank you, Jennifer, and thank you everybody for joining us today. As you can see, SPFL Consulting team, we have over 45 years of experience and we offer all the services listed, but in particular, today's topic is perfect. You know, considering it's December 11th, it's year end, all these topics are front and center on your minds. And as we're working with all of our dental clients and having year end meetings, all these topics at some point come up because the number one question we get is, how do I pay less taxes? Okay, how do I take advantage of this new tax law? What does it mean to me? And so as we're going through meeting with our clients on all these various services, these things come up. And we help our dental clients with putting in the best practices to maximize their profitability, minimize their taxes. And it all depends on where you are in your career and where your practice is. We have a lot of different people joining us today, and whether you're a startup, just purchased a practice, whether you are a mature practice, growing, maybe looking to sell in the next 3 to 5 years, everything that we're covering today will apply to you, okay? So with as many things as we could cover, if you're counting along with us at home, you'll notice that we're going to cover 10 different topics today. So we'll get started with entity selection. There's been a lot of talk about this since the new tax law was passed. Again, I mentioned that we have a variety of attendees, okay? Reviewing your entity selection is very important because if you were to ask us, what type of entity should I be? The answer might be different when you start the practice if you're very small. It might change as you grow or if you purchased a mature practice. And then we want to make sure that as you're getting ready to sell, you're in the best position from that standpoint. There's no one size fits all, okay? I would say typically, you know, if you're just starting out, if you're a small practice, if, you know, initially your revenue projection is low, you're probably going to go ahead and form an LLC and be taxed as a sole proprietorship. If you purchase an existing mature practice, you're probably right away going to create an LLC and be taxed as an S corporation, okay? The other thing we always want to make sure you do is if you own the real estate you practice in, that you have that in a separate entity. So the takeaway on this topic is have the conversation. If you haven't, is my entity right for me right now based on the new tax law? It depends on your income. It depends on whether you own the real estate or you rent the real estate you practice in. It can affect the benefits that you offer in the practice. And with the new qualified business income deduction, being a pass-through entity can save you significant taxes. And so on that note, I'll pass it over to Justin.
Particularly talking about, oh, thanks, Andy. Okay. In the Tax Cuts and Jobs Act of 2017. QBI, also known as Section 199A, what is it? It's a 20% flow-through deduction for flow-through entities. A flow-through entity would be an S corporation, partnership, or sole proprietorship. This could include rental property. Again, what is it? So it's a maximum 20% deduction box number 1, there are a couple of limitations that can come into play. And I will say this topic by itself could easily be a multiple hour webinar. We're putting a lot into 30 minutes, so this is going to be very high level and to give you some triggers to think about items to plan for. So one of these, box 3, is there's this deduction phases out for service businesses. So this is important for the dental industry. Service businesses, or specified service trade or business as they're called by the IRS, include services in the field of health. So this would include dental practices. What does this mean? It means while other businesses such as a manufacturer or even an architect could qualify much easier for this 20% deduction, being in the field of health, you're going to have phase ins and phase outs of this deductions based on your income. Let's see what these phase outs look like in a chart here. So what we have is on the left, we have what your taxable income is before this potential deduction. And then we have in the middle column, if you're in a service business, i.e. a dental practice. So as your income is less than $321,000 married filing joint, or $160,000 roughly, you're going to be eligible for this 20% deduction, even if you are in the field of health. As your income goes, so there's a phase out of $321,000 to about $421,000, where you're still going to get this flow through deduction. And then if you're in the field of health and your income is over those limits, you are not going to get this 20% deduction. So the entity election that Andy was talking about, the income, some of the other deductions that we're going to talk about later, all factor into where is your ultimate taxable income going to be, and can you benefit from this deduction? I just want to look at a couple specific dental practices now. So on the next slide, because we have a lot of our dental clients that will say, oh, I'm certainly not going to get this deduction, and some of them aren't, and some are going to say, you know, I'm not really sure how much. I just want to give you an idea of, we have low, average, and high on here. It's just for the purposes of illustrating, but this low practice that has collections about $760, overhead of $456, and dentist compensation of about $300, excuse me, and $4,000, that low practice would qualify for this 20% deduction. The average one is going to qualify for a limited deduction, and the high one shown on here is going to not qualify for this deduction. So I kind of we wanted to put together a quick summary to kind of give you an idea of at what size income practices does this deduction truly apply to. To throw a couple more numbers on the page, because we're accountants, just to give you an idea of what that exact deduction is. So for that low practice, I'm going to just hit the highlights here. $304,000 of practice profit. This is an LLC reported on a Schedule C of an individual tax return. The 20% QBI deduction for this level of income is $60,800. A deduction of $60,800 is certainly nothing to sniff at, so certainly worth looking into. Just real quickly, looking at that average practice that we talked about, and to show how the limitation comes into play. I'm not going to go through all the mechanics of how that's calculated, but so we went from $304,000 of profit to about $400,000 of profit. LLC reported on the Schedule C. Because of the limitations that are starting to factor in, that $60,000 deduction is limited to $12,000 based on the facts of this practice. And don't want to get into too much of this details, but QBI is certainly an important item to factor in with year-end planning. It may make, we'll talk about depreciation later, purchasing an equipment and taking deduction may get the income all of a sudden to where you weren't qualifying for this deduction to now with that extra depreciation, you may qualify for QBI. So a lot of moving pieces coming together. The next topic we're gonna transition into is one of the, another highly discussed and commented one that relates to the retirement plan. So with that, I'll transition to Andy.
Again, one of the number one questions is, how do I pay less taxes? Okay. One of the top ways, maximize your retirement plan contribution. So the first question is, do you have a retirement plan in your practice? Okay. Could be I don't know, could be I think so, could be I haven't checked in a couple of years, but That's the first thing to go back and check if you're not sure. You could have a simple plan. You could have a 401k plan with a safe harbor or match. Some of you add a discretionary component to that plan. And some of you who really are in a position where you want to put big dollars away in a short amount of time, you could add a cash balance plan. It just really all depends on what do you have, what do you want to accomplish, okay? So you answer that question, yes, I have one. The next question is, well, are you using it, to its capabilities? And even if you are, most important question on this topic for today is your retirement plan the right plan for you right now, okay? And again, it's not a one-size-fits-all. Some of the conversations we have is, yeah, I have one, yeah, I could put more money away, but it's a cash flow issue. I need cash flow right now, I don't have it, okay? Another consideration is, how much tax do you want to save? And what do you want to do with that tax savings? Another consideration is its benefit for your staff, okay? Right now in this tight labor market, okay, the market's demanding more benefits, higher benefits. One of the ways to appease your staff is by having a great retirement plan in place relative to your competitors and where your staff could be looking to move at this point. So all those things have to go into consideration. One of the advantages or some of the advantages of beefing up your retirement account, of putting more money away, number one is you put yourself in a position to retire when you want to retire. And everybody wants to retire sooner, right? That's what everybody talks about. So the sooner you start putting money away, the sooner it starts to compound and grow, the sooner you can meet those retirement goals. Number two, topic today, you save taxes, okay? Think about it. You put a big retirement plan contribution away each year. That beefs up your retirement account. You also turn around and save potentially 40% in tax on that contribution. Okay, what do you do with that 40%? Instead of paying it to the IRS or paying it to the Wisconsin Department of Revenue, you pass some of that savings on to your staff. And again, in a really tight labor market, that puts you in a competitive advantage to retain and recruit that staff. So other than those talking points, the other thing I wanted to highlight in this section are the new limits. This is about the time of year where we get phone calls. How much can I put away into my IRA? Looking ahead to 2020 and setting my payroll limits in the system. How much can I put away for 401k? If I'm under 50, how much can I put away for 401k? If I'm over 50, oh, by the way, how much of my earnings next year is going to be subject to Social Security tax? So again, a lot of information on this slide, but I think those three items are some of the more common questions that we get in this area. And since I kind of ended this topic talking about staff, this is kind of the perfect segue to start talking about some tax-free perks that you can offer your staff.
Thank you, Andy. And so with tax-free fringes, so this is, as Andy said, a benefit that you can offer to the staff. So it's an expense that you're deducting and they're not paying taxes on it. So certain, it's non-taxable to them. And this would also, many of these, if not all of these, also relate to the owner as well. So when we're talking staff, we're also talking all employees, which includes the owner. So as we're having these year-end meetings, we're very much discussing, as Andy said, minimizing taxes. And part of that is making sure that our clients are recognizing all the deductions that they are entitled to. So we have a quick list here, and again, we can't get too deep into any of them based on the timing of today's presentation, but please reach out if you have any questions on these. So insurance. So this could include health, which includes dental and vision, life, disability. I think a very underutilized, insurance benefit, which is very cost effective, is employer provided life insurance for their staff. Your employees are obviously a big part of your team, and also your life. You spend many years with these developing relationships. It's very nice to just know that their family has a little bit of peace of mind and a little fallback to have a really inexpensive benefit such as $50,000 of life insurance for your employees. Really inexpensive. So Andy talked about the retirement plan. We'll skip over that. Dues, licenses, and memberships. Those really fall under some professional business ones that we're going to dive into a little bit more. Achievement awards. So these awards for really safety or for length of service. you know, the IRS does have, of course, some requirements, but can be pretty generous as far as some things that you can give your staff for, such as a 5-year anniversary, 10-year anniversary, et cetera. And if you follow the IRS guidelines, you get to deduct that as a business expense, and your employees have no taxability from that. I will say be careful with cash. We get that question a lot. The IRS will say that any cash payments to employees should go through payroll. So just be careful with that. Know that is something the IRS looks at, and it may want to do an achievement award as opposed to a cash payment. Cell phones. So if used for practice, if used for the business, you can certainly reimburse cell phones, computers, and that could include a computer that is at home. You know, you go home at night and work on some of your back office functions. Absolutely, that computer would be a potential deduction. Personal residence rental exclusion. This is kind of an interesting one. We get a lot of questions on it, and it can be okay if done correctly. So what this says is, if you have a piece of property that is not truly a trade or business, but you rent that occasionally, you do not have to pick up that income, the rent payment, as income. So what you could do is, if you had a cottage in northern Wisconsin and you took your staff there for a weekend for a benefit, the practice could actually pay fair market value rent to the owner of that property, i.e. you. So you would get a deduction for that payment and then not have to pick up the income on there, since it is not a trade or business. On-site athletic facilities, you know, it's amazing what you have some conversations and you throw it out. And I actually had one client who, as they were looking at very much into fitness, and they just decided that as they did a build out of their practice, instead of having a home gym and getting no deductions, they actually had they put in a gym at the practice, which their employees get to use as well. It's a non-taxable benefit for the employees, and some of these pieces of equipment are now assets of the practice and deducted through the practice. De minimis, minimal benefits. Again, this is minor gift cards, little gifts to your employees. If it's de minimis, minor, that can be a fully deductible benefit, not taxable to them. Education assistance. You know, the job market's getting tougher and tougher, and you may have a really good assistant that you would like to be a hygienist, or we've seen all sorts of things. Continuing education for office managers, there are options to help your employees with their education and get a deduction for it. One of the big things here is you have to be careful with discrimination. Business travel, certainly a valid deduction with the new tax law. The next one we want to just touch base on is, so meals are certainly deductible, but entertainment is no longer deductible. The last couple perks that I want to just go over are what I call the occasional ones. So while entertainment's no longer deductible, occasional parties, i.e. the company holiday, Christmas party, fully deductible. Occasional tickets for theater or sporting events. You know, if you take one of your staff to a sporting event and it's an occasional item, it could be excluded from that entertainment classification. And one that is just a fantastic benefit, heavy sarcasm font used, the occasional personal use of the company copy machine. That is straight out of an IRS handbook. So as long as your staff aren't using that more than 15%, you do not have to add that back to their W-2 at the end of the year. I'm sure everyone is tracking that closely. Now just transitioning into another one that we get a lot of specific questions on that really fall under this. So professional business expenses.
So again, this time of year, this is a big one, right? Have you made sure that all of your professional business expenses are paid or reimbursed to you through your business? Now, there's no all-inclusive list, okay? Quite frankly, what I always tell my clients, because some of them get real creative. Can I deduct this? Can I deduct that? I always say, okay. When you get creative, just picture you're sitting across from an IRS agent. You can justify the expense as being quote-unquote ordinary and quote-unquote necessary as a part of your business. Go ahead and run it through, okay? Now, what are the typical ones we see? Continuing education, your dues, your journals, your licenses, your phone, you know, computer, internet as related to your business. You know, those are very typical. Best practices, make sure you keep all your receipts, okay? No one ever wants to get audited. No one expects to get audited, but we do see audits from time to time. Please keep a copy of your receipts in case they're ever questioned. Timing, okay? This one, some people get caught in, okay? The IRS says, we're just the messenger, the IRS says that all of your professional business expenses should be reimbursed within 60 days of incurring the expense, okay? Now, I've got plenty of clients who at the end of the year go back to the beginning of the year and get all their business expenses turned in and reimbursed. Again, just telling you, IRS says 60 days. So here's what I recommend. Best practice, anything that should be paid by the business, okay, business related that you pay personally, have a separate business credit card and use that for all your business expenses. End of the month, when you get the bill, turn it into your office manager. Have it paid. What have you accomplished? You've kept business and personal separate, which is always a big thing, okay? So you've kept that separate. Second thing, you stay on top of it, okay? Everything's timely. You're way ahead of that 60 days because you're doing it once a month, okay? On that note, spending money here and getting it reimbursed, let's talk about, Justin, some of the opportunities on the depreciation side.
Certainly. So at the end of the year, all the equipment vendors are mentioning Section 179 and bonus depreciation, and they likely have some incentives too, where, hey, if purchased by the end of the year, the financing works out well. So a lot of opportunities to purchase equipment. Just want to give you some tips and some things to think about as far as how that deduction works through the practice and what's valid. So bonus depreciation. So prior tax law was still pretty aggressive depreciation. You could bonus, which means take a deduction immediately for 50% of the purchase. And I just want to understand, so when I say purchase, I mean that you have either, you have financing in place, so you paid with cash, or you have a loan commitment, and you have this asset placed in service in your practice. So it isn't installed and you're using it. That's the IRS definition of in service. Once it's in service, you can take a deduction. So whether or not you are paying cash or financing does not impact the depreciation. That's a separate consideration. But it's 100% bonus is available for new or used property, and that applies to property with an IRS tax life of 20 years or less. So really, any equipment, furniture used in your practice, you can take 100% bonus. It even includes some land improvements and some qualified improvement property, i.e. build-outs where you're not expanding the actual footprint of your practice, but really anything that you're adding walls and doing anything for a build-out on the inside of the practice. Bonus is a little bit different than what's called Section 179. Section 179 is an additional type of depreciation that the IRS allows. So they let you take bonus depreciation, and then additionally, they'll let you take $1 million of 179 as you purchase lots of equipment. If you purchase over 2.5 million, that limitation will phase out, but realistically for most of our clients, everyone has the potential to purchase and deduct $1 million of equipment plus some bonus. There's a special $25,000. We call it the SUV rule. It's really for equipment with a gross vehicle weight of over 6,000. So any full-size SUV or full-size truck, you can have a special $25,000 limit for 179 there. This also, Section 179, like bonus, includes some land improvements, some details here. So just comparing Section 179 and bonus, the next chart, why would you take one versus the other? Section 179 is limited to the practice income, so it can basically take you to zero, can't take you below zero. Bonus can create a loss. 179 is followed by the state of Wisconsin. Bonus is not. 179 you can allows for pick and choose, meaning you can take it on one asset, not take it on another. For bonus, it's an entire asset class. Very aggressive depreciation rules right now. You know, certainly everyone likes the idea of let's take as much of a deduction as possible. However, we actually have many conversations where we're saying, hey, we could take the most right here, but we're actually going to knock you down a couple tax brackets, and let's spread that deduction out over 5 years so that you're getting that deduction at a 35% bracket as opposed to a 35, a 32, and a 24 if you're taking it all this year. So it's great to have the ability to take a lot of deductions, but you do want to make sure you're planning appropriately so you're getting the biggest benefit. One other thing, as we're talking about depreciation quickly, vehicle depreciation. The IRS has greatly increased vehicle depreciation. Now, this does have to be primarily used for business. So if it's a one-office dental practice, it's a lot harder to justify a business vehicle as opposed to a multi-office clinic where you can certainly justify your traveling between offices throughout the day. To quickly illustrate how long it would take you to write off a vehicle, you could write off a $50,000 vehicle in about 6 years with the current tax law. It would take 20 years to do that in the old tax law. All right, so quickly with that was quick vehicle depreciation. The next topic that we want to talk about relates to charitable contributions.
Thanks, Justin. The new tax law has completely changed how we make charitable contributions if the goal is to get a tax deduction for them, okay? So consider the effect of the new standard deduction. Okay, for 2019, a married filing joint taxpayer, the standard deduction essentially is double what it used to be. Now it's $24,400, okay? Your real estate and state income tax is capped at $10,000, okay? So simple math, $24,400 less $10,000, we're left with $14,400. If you don't have a mortgage, okay, the first $14,400 of charitable contributions that you make in any given year is out of the goodness of your heart from a federal level. You get no tax deduction, okay? If you do have a mortgage, then you get to deduct the mortgage interest. So you take the $14,400 plus the mortgage interest. That's the amount that gets you no tax benefit, okay? So if you say, well, I like doing charity, but I also want to get a tax benefit, what do you do, okay? First thing I think you should do is looking out 2, 3, 4, 5 years, how charitable do you want to be, okay? Who are you? What do you want to do? So one thing to consider is it's called a charitable fund. It's called a donor advised fund. You hear it called a few different things, but technically it's a donor advised fund. You get the deduction in the year you fund it. So let's say I want to contribute $100,000 to charity in the next 4 years, okay? Well, you can take the deduction in year one, fund the donor advised fund $100,000. That becomes a checking account for making those donations. And if you want to make them over the course of 4 years, take $100,000 divided by 4, you can still give the charity their $25,000 each year. Year one, you deduct $100,000. In year 2, 3, and 4, you take advantage of that standard deduction, okay? Appreciated stock, you can put appreciated stock in that donor advised fund. That achieves 2 great things. 1, you avoid the capital gains tax on that appreciated stock. 2, gets you well over that standard deduction in that year you fund it. Last thing on this topic, if you're over 70 and a half, or if your friends are, parents are, relatives, etc., you can talk about this. Probably the most powerful way to fund charity from a tax perspective now is if you're 70 and a half and you're in those years where you have to take your required minimum distribution, is you can take up to $100,000 of that required minimum distribution and fund it directly to charity. Okay? Very powerful because that was going to be required taxable income, but any amount that you send to charity, not taxable income. Number 2, it reduces your adjusted gross income, which may help you from that new 3.8 net investment income tax perspective. And lastly, if you're taking Social Security, you might monitor very carefully how much you're paying in Medicare premiums. Having a lower adjusted gross income can reduce your IRMA calculation and how much you're paying for Medicare. So again, very beefy topic, but the new tax law really changed how we fund charity, and you really have to have that conversation if that's your goal. Justin, next topic, employing your family.
Yeah, another one that we get a lot of questions on, and just to highlight the changes of our new tax law and how this impacts employing of the family. And as a reminder, Andy mentioned before that it's got to be an ordinary and necessary business. If you're going to employ a family member, they must work in your business. Some examples that we've seen, we've had piano in the lobby, having a son or daughter play the piano for a couple hours, a few evenings here or there, shredding documents, cleaning, advertising. Presence in the lobby, we've actually had one client that their biggest family member was a pet of theirs, and they had a pediatric practice, and they truly used their golden retriever as advertising for their practice, and it roamed the lobby. So after a few conversations, we decided to deduct part of the dog food, et cetera, relative to this advertising in the office. For employing your family members, so the standard deduction for 2019 is $12,200. So if you were to employ a child, let's say, you could get a deduction for $12,200 if that was through the payroll of your company and that was a valid deduction. They would have no income tax on that income based on the standard deduction covering it. So the cost to the business for doing that would just be the payroll taxes on that wages, and then what you have effectively done is you've shifted that income from your tax bracket down to a 0% income tax bracket. Some other benefits of employing a family member is it can be part of the company retirement plan if you have it, as Andy mentioned, if that's a plan through the business, or to contribute to a Roth IRA, you have to have earned income. So it's a great way to get children started on retirement savings is if they are working a few hours a week in your practice, having them get a W-2, which allows them to contribute to a Roth IRA and get started on their retirement. So just a couple quick things on employing a family member, which is certainly a valid and viable business deduction, and there's some very nice benefits to that. So a couple more, and we're going to transition to just some other year-end considerations.
So this is the old bread and butter, okay? This is probably the oldest tax conversation in the book, is can I defer revenue into the following year, and can I accelerate expenses into the current year, okay? We live in an electronic world now, right? So there's very few paper checks that exchange hands, very little cash is paid. So that deferring revenue, there's not a lot you can control, but what you can control, that's certainly a consideration. Expenses, at a minimum, look ahead to January. What January expenses can I pay in December? Okay, most of you are cash basis, so it's when you receive the money and when you pay the bill. So again, as dentists, what are your biggest expenses? Your staff, your lab, your supplies, your equipment. So get that lab bill paid in December. Any supply purchases looking out, get those paid in December. As Justin alluded to in depreciation, if you have a need for equipment purchases in the next 6 to 9 months, let's buy them now if cash flow is not a consideration. Okay, on to the last one, big topic, the pass-through entity tax for Wisconsin.
Yeah, so this is a big one we've had a lot of conversations on, and this is really a result of the changes to the federal tax law that really removed the benefit of state and local taxes. So this was Wisconsin's way to say, hey, we have a state that has relatively high real estate and income taxes. The income tax piece, we're gonna make this deductible by having an election to pay these taxes through the entity as opposed to individually. So it's for flow-through entities, so you need to know if you're a flow-through entity, and for that definition, again, it's S-corps, partnerships. For S-corps, this was in play in 2018. For partnerships, it's in play for 2019. And I really just want to highlight, we have a couple slides here, and it does get pretty technical, but what I'll say is if you know what your flow-through income in, and you're a top tax rate payer ballpark, the effective tax savings of making this election is about 2.7%. So if you have $100,000 of flow-through income, by making this election, it would save you about $2,700 a year in taxes. And we have a couple slides here going through some of the mechanics of it. I don't want to get through that. I just want people to be aware, hey, if I'm a Wisconsin taxpayer, I need to at least consider this election if I have not. So with that, we are going to actually open it up for questions.
Yes, we are. We are at our 30-minute mark, but we wanted to take some time to answer the questions that have come in. If any of you out there have questions, remember that you can type them in the chat box and we will take the time to answer them. One of the questions that came in during the presentation was, how do I go about having my retirement plan reviewed or analyzed? Who wants to take that one?
Yeah, I can go ahead and comment on that one. Like I said, first thing is to find out what do you have in place, and then really we would simply need a copy of probably your plan documents and maybe last year's contribution, And then we have experts in-house here who can partner with your third-party administrator to take a look at that and see, is it effective? Is there a better way? What are the potential tax savings for me?
All right. Next question, how soon can I put my child on the payroll?
Very, very good question. Getting into some labor law issues here, so I'll throw the caveat that we're not an attorney and can't give legal advice. However, we do get this question a fair amount, and what we've essentially, there's a little bit more aggressive answers for when you are a business owner and you're employing your family, and that really relates a lot to Wisconsin's, agricultural history and background. But bottom line, it's about 12. About 12 years old is when you can start employing a family member in your practice.
All right. So we are going to wrap it up here. If anybody out there has any further questions, both Justin and Andy's contact information is on your screen. Feel free to reach out to them at any time and they'll be able to help you. Again, I want to thank Justin and Andy for the presentation today and thank everybody for joining us. Have a great day. Bye-bye.